Guys, Chris has been in many industries, got into investment banking before founding his own software company, DemandJump, in 2015. Grew that to $1 million in revenue fairly quickly, first 18 months, raised some capital, realized how VC worked inside of the company, and then said, you know what, man, it's time for me to go give back. And ultimately was recruited in a very competitive process to run Elevate, which is one of the most active seed funds in the world. They've got, you call it the most active in Indianapolis and that Midwest region, with over 500 total investments, $5 billion economic impact, now focused on giving back to entrepreneurs and supporting companies, whether it's software, health tech, fintech, etc. Hey, folks, my guest today is Toph Day. He's the CEO of Elevate Ventures, the number one most active seed and early stage investor in the Great Lakes region and number 24 in the US. He's an innovator, entrepreneur, business creator, community builder, job maker, and wealth creator. Through his endeavors over the last 30 years, you guys will respect what he did as co-founder and chief executive officer at DemandJump. He focused on that for over 7 years. Toph, you ready to take us to the top?
Yeah, absolutely, Nate. Nathan, I'm glad to be here. Let's roll.
All right, let's roll. So let's talk about your street cred first before we talk about your investing. So street cred, DemandJump was launched, I think, in 2015. Was that your first software company?
No, my first software company went back to probably in the year 2000-ish, 2002-ish, when we built some billing software for the utility industry.
Interesting. And so did that work well, or was it sort of a crash and burn and you take the learnings, put it in DemandJump?
Oh no, we crushed it. So we have I've started 8 companies in 7 different verticals over the last 25 plus years, and those have been in hard tech and software, investment banking, commercial real estate, family entertainment, .com, all kinds of different businesses. Did bottled water. That was my one failure. I failed at the bottled water business.
That's a hard one. Okay, so what was DemandJump's sort of texture? Was it bootstrap? Were you all in on the equity side and raising as much as you could? How did you build the business?
Yeah, we initially started DemandJump providing largely services, right? So we were trying to use machine learning and AI to figure out some things. We actually wrote a book. The shameless plug. We just released this book a couple of weeks ago.
Pillar-based marketing for those of you listening on audio only.
Yeah, on Pillar. It's called Pillar-Based Marketing, a data-driven methodology for SEO and content that actually works. We just released that a few weeks ago. But the concept was everybody writes tons of content. And now it's been exacerbated by ChatGPT, right? So people are writing more content. And there's all different kinds of use cases for content. But the use case we were trying to solve was, how can I write content that people will see, my target market will see when they're in research, decision, or buy mode, drive those leads to me to give me a shot at selling my product or service to that target customer.
So were you, like, I'm looking at the headline right now, more page 1 rankings, more customers, more revenue. I mean, are you like connecting companies with an army of writers to put out the content, or is it more like AHREPS or SEMrush where it's truly SEO software?
Yep. So it's a 1-2 punch. So there's a software, there's a platform that you enter in any pillar topic. So that pillar topic could be coffee mugs or sales forecasting or whatever. It doesn't matter what the industry, what the business is. But in the B2B use case, you enter whatever you're selling. It could be cybersecurity. It could be SOC 2 compliance, whatever it is. You enter that topic, that pillar topic, into the platform. The platform, in less than 10 minutes, maps out the entire world around that pillar topic in your website against your competitors' websites to understand what is the roadmap, what are the words and the questions that are most highly connected to the center pillar topic, and exactly how you should structure your content that maps to how the human brain actually thinks.
Interesting. Okay, and you got that going in what, it was 2015, right?
Yeah, it took us probably 5 years to figure out that use case that we just talked about. We just launched that a couple
wow.
years
So
ago.
like 2015 to 2020, you would call that figuring out mode?
Yes.
Oh, wow. Okay.
It's a beast. It's about neurosciences, and it's a very complex problem to solve.
How did you manage the storyline, though? Because when I look at your Crunchbase profile, you raised funding during this period. So you must have had some track record to point to inside the company to say, hey, give us $5 million.
Yep. Yeah, we were originally doing, I'll call it analytics. It's like marketers spend, 80% of their time trying to figure out what to do. And so the whole purpose of DemandJump originally was cross-sector in those various marketing channels, helping marketers understand what they should go do, right? Helping them reduce the time figuring out what to do and just get down to brass tacks on here's the next 5 things I should do that are most powerful.
Interesting. So, Chris, how many years did it take you to hit him at your first $1 million year at that company?
Probably 18 months, 2 years.
Oh, so it's pretty, okay. That's pretty rapid. That's not too long. Okay. So 2017, you're doing $1 million a year. Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time. You can see what it changed over the past 88 days and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your FounderPath dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right, so the teal is what a VC would pay, yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise, they sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of FounderPath, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here, and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview. And then why did you decide, there's obviously two very choice, usually I hear the VCs thing, it's usually on the coast. You're in Indianapolis actually, but you still chose to go sort of the heavy, raise money route. Why not bootstrap?
Because to figure that out requires data scientists, machine learning engineers, people that make a lot of money. And we didn't have, that kind of bankroll to bankroll the whole thing. And so that's why we raised some money.
That's fair. This will pair nicely into Elevate as we build into that part of the story. But dilution is something that a lot of first-time founders, they don't understand how to manage until they're burned once. They go through their first whole startup and then realize, okay, that's how dilution actually works. That's how Carta actually works. That's what a fully diluted share actually means. How did you manage dilution as you were growing DemandJump?
So I don't think about dilution. There's a I'll call him a platinum level famous investor. His name's Bob DeVoley. He's out of Boston. He used to be on the cover of magazines back in the .com era. And I agree with Bob's concept here. I don't think about it as dilution. I think about it as the opportunity. People start companies for all different kinds of reasons. There's no right or wrong way. But if you're raising venture capital, I don't think about dilution. I think about it's 1 step or 2 or 3 steps closer to achieving the solution that you're trying to actually build. And so would you rather that be successful and get in market or not? Would I rather have 100% of $50 or would I rather have, 10 or 15% of $1 billion? That's how I think about it.
Well, I mean, that's obviously certainly what we all like to think about. That's what we're dreaming of as founders and entrepreneurs. But just because you raise, it certainly doesn't guarantee that you're going to go be what you just described, right? Which is a $1 billion success story. So when you go raise $6 million in your Series A in 2018, you put together a thesis on what you guys want to go build. But again, most folks in their Series A are selling 10 to 15% of the company, right? So if you're, raising there at a 60, 70 million valuation, selling 10 to 15%, and then things don't pan out and become that $1 billion story, then what? Do you try and buy them out? Do you leave? It sounds like maybe you leave. I mean, how do you manage that?
No, you pivot and you restack the capital stack. You do whatever you have to do, right? To make
sure. What does that mean? Restack the capital stack.
So if you have to do a down round, you just go through that process. Whatever it takes to make that company successful, you make those decisions as you go. So I think that investors over the years, it's just like in real estate, things get really hot and new words get invented, new technology that actually add value come out. And I think investors a lot of times put undue pressure on entrepreneurs. And, so there's concepts out there like the triple, triple, double, double, double. Or there's, 150% growth rates and 120% net dollar retention, all these best in class statistics. And there's people on the coast that get funded with large sums of money, right? And a lot of that money ends up getting wasted. And sometimes entrepreneurs are trying to figure out, AI is a difficult thing. Machine learning is a difficult thing. You're going to go through a lot of trial and error to try to truly figure out something interesting. And, a lot of investors today, break even, running the break even line is now sexy, right? Or having a burn rate that's, let's say, $100,000 a month or less versus $300,000, $400,000, $500,000. And so the investors that were trying to encourage high growth and maybe product market fit had not been achieved 100%. Now all those companies are going through down rounds, right? And adjusting the valuation to raise the next round of capital that's required to still grow. And so a lot of investors think 50% growth, 30, 40, 50% growth now with great unit economics is an awesome thing, right? 50% growth is the new sexy as compared to 100 or 150%. Because in those early days when you transfer, it's so hard to transfer from founder-led sales to process-led sales. That is a big deal. And often companies try to cross that chasm too early, which ends up in several $1 million of lost investment.
Mm-hmm. So take us now into Elevate. I'm going off your LinkedIn. It looks like you left DemandJump in what year and why did you leave?
Yeah. So I've been passionate about venture capital for the last 15 years. I had an investment banking firm. What was that in 2017? I forget my years already now. 2009 timeframe, 2008, 2009 timeframe. Started an investment banking firm and was sitting on the other side of the table, right? So I've been an entrepreneur, been an investor, and now with the investment banking route. And I just became really passionate about the funding continuum here in the middle quarter of the United States, and especially in Indiana, living in Indianapolis. And so I see all of these awesome companies that are starting right here in the middle corridor or in Indiana, in Indianapolis. And it's really hard to access capital, to access talent, to access the investment banking services when they go to exit. And so the opportunity came to lead Elevate. I like to call it Elevate 3.0. And the opportunity came around to lead Elevate, and I couldn't.
What does
pass
that
it
mean,
up.
Chris? Did they recruit you at a DemandJump? Like it was already a fund structure in place or something? What does that mean?
They had a national recruiter. And so that national recruiter reached out, and they were talking to, I think, several hundred people across the country looking for the next leader. And the national recruiter reached out, and we just started talking.
How do you manage? I mean, you don't want your baby to die either at DemandJump. I mean, I don't know how many full-time folks you had there, but it sounds like you may have managed through maybe a down round, and then you sort of have to leave. How do you make sure morale doesn't plummet when you leave?
We had an incredible leadership team. The leadership team at DemandJump, I would just say, is second to none. They're incredible. And I think all of those folks are more important than I was, right, at that point. Mm-hmm. So we had a great leadership team. We had a strong culture. And I felt confident that bringing in a new CEO to keep, to take it into the growth phase was the right thing to do for the company. So it all worked out. It all worked out great.
Are you comfortable sharing how many folks were full-time when you decide to leave?
When I left, there were we were high 30s.
High 30s. Okay.
Yeah.
And are you comfortable sharing a revenue range when you left or no?
I probably shouldn't share that, right?
Okay.
I'd leave it up to the current CEO to talk about those things.
Yeah, that's fair. We like to try and guess at that by taking an average ARR per employee for companies like this, which would put you guys somewhere between, call it 3 and 5 of ARR. But again, that's just a guess. But point being, you were recruited. You were recruited into Elevate. And then talk to us about Elevate. So what's the fund structure at Elevate? We can see you've done a lot. I mean, on Crunchbase, it looks like over 200 individual investments. So what's the fund structure?
Yep. So we've done over, I think it's 520 investments throughout Elevate's history. So Elevate is the number 1 most active early and seed stage investor in the Great Lakes region, number 24 most active in the United States. We have $215 million in assets under management.
Is that measured by, Chris? Is that just measured by literally volume of deals?
Number
you put
of deals.
At least $1,000 in?
Yeah. And the lowest, we write checks from $20,000 to $2 million in any given round, up to $4 million in any given company. We invest in the ideation, pre-seed, seed, and Series A portions of the funding continuum. We invest cross-sector, so that includes anything from SaaS to hard tech to sports tech to healthcare. We even do some med device, food, ag. We truly invest cross-sector. And we've invested about $156 million to date, and that's been co-invested with another $2.1 billion of other VCs, throughout the whether it's the state or the nation or the globe, of other investors that are invested alongside of us.
And I cut you off on accident earlier. What was your total AUM? What's the total amount of funding that you guys have raised?
$215 million.
Okay, over 2 funds?
It's an evergreen fund. So we have a total of $215 million in assets under management.
I see. Okay. And 156 million deployed to date. But the big number, especially right now when the water's going out and we're seeing who's wearing a bathing suit, is DPI, right? So how much have you guys paid back out to investors?
So it's evergreen. So we just keep reinvesting it. So our LP, we in essence have one LP, which is the Indiana Economic Development Corporation. So we work with the state, and so it's state and federal dollars that we deploy, and we just keep recycling those investments.
I would consider that an unfair advantage. That's good for you, but not standard, where most folks have to go raise from a bunch of different LPs and they got to manage, distributions and all that jazz. The government council there doesn't want you to deploy money back to them. They want you to reinvest it and recycle it back into the fund to support local startups, right?
That's right. And we've had a $5 billion impact on the state of Indiana over the last 10 years.
How do you measure that? What does that mean? How do you get to $5 billion?
So we look at the co-investment that we've driven into the state. We look at the annual payroll of our portcos and the employees. We look at the payroll taxes that are paid to the state. We look at sales tax. That's a revenue source to the state. So when you add all those things up, it's about a $5 billion. It's actually probably more than that, with various ways you can measure the various ways you can measure economic development. But yeah, it's a massive number.
How do you, I know we all know how sort of a traditional VC fundraise, but at the risk of being like too sensitive here, how do you make money off this? Is it traditional 2 and 20? You taking a management fee, or you get carry, or what?
Nope. We have a contract to execute the deployment of those dollars. So it's just a professional services agreement that we have. And
variable. It's just a flat fee for management. If something goes and sells for $1 billion, you don't get, some small cut of that.
No.
Oh, interesting. Do you ever go, man, look at this $1 billion exit we just had. I wish, I had a regular VC fund so we could get some of that extra upside.
Well, I think there's ways that Elevate 3.0. I think there's ways that we can, with all of the track record that we've had. I think there's opportunity in the future to other people who may have interest in us managing their funds in a more of a traditional manner. I think those opportunities are out there, and to also move up the funding continuum in the growth equity phase of it. So those things I think are definitely on the future path.
You think like majority minority recaps, main sale style sort of stuff, or what?
No, I think so. For example, moving upstream into Series B, into growth equity, I think it's a real possibility, and there'd be more of a traditional fund. There are other institutions, organizations that have large amounts of dollars that they want to deploy in a more traditional format, to get a return on that investment, but to drive more new company starts, help companies, that they know grow faster and more efficiently. I think those opportunities definitely exist out there.
Writing a book is not easy. I remember how long it took me to write mine, and Portfolio Random House grilled me to the ground in terms of detail, and it was so much work. Why take the time to write pillar-based marketing? And it's congratulations on the launch. It looks like it just came out in late March.
Yep, absolutely. So it took about a year, right? I don't know how long it took to write your book, but it took about a year. I wrote it with a gentleman named Ryan Brock. Ryan was the CEO of Metonymy Media. We bought Metonymy Media when I was leading DemandJump. So that was a little over a year ago, December. We acquired Metonymy Media. And the reason we wrote it was the world of SEO is just littered with, I'll just say, hacks and, just a disaster, honestly. Just SEO's a blank show. And people always promise some magic bullet, et cetera. And there is no magic bullet in SEO. And I think it really couldn't be solved because we didn't have the database structures and the computational power to actually solve it historically with the growth of the internet. And there's just a lot of myths, I would say. There's a lot of marketing myths in around SEO, actually marketing in general. And so we wrote the book to kind of once and for all lay out the story from beginning to end, like all the pain that marketers have suffered over the last 25 years of the the launch of the internet and the growth of the internet, and just to walk people step by step through all the things that we all experience so that we can establish validity, that we understand what we're talking about, and then how we approach the problem differently, and then what the results of that solution are. But like even today, I see all over LinkedIn, people are like, oh my gosh, ChatGPT is here. Our problems are solved, right? We can put stuff into ChatGPT and we can write content till the cows come home. And that's true. But some people are conflating that with it'll work for SEO, and it just simply won't. The internet was built for people to find products and services. It was not built for products and services to find the people, the target market. And that's what DemandJump solves, is the ability through any pillar topic to understand I don't know what you're thinking right now, right? You could be thinking, I want to go to Chick-fil-A, right? And get a sandwich. I'm starving, right? And so the internet is a pure reflection of the human brain at this point, right? We've been talking to smart devices now for how many years? 10 plus or minus years. And so the internet is an absolute reflection of the human brain now. So we applied math, right, and neurosciences to all of that data to understand how all of these words are connected and basically mirror the network of the human brain, which is the internet. And that's how all the search engines work, right? They want to match a human most closely aligned to what they're looking for in that moment. And that's what the math does.
Guys, so check it out. Pillar-based marketing. Chris, we're out of time, or Toph, we're out of time for today. Let's wrap up here with the famous 5. The first one's always your favorite book. We'll put pillar-based marketing in there. Number 2, who's a CEO you're following or studying?
Oh gosh, I follow pretty much anybody.
Name one in Indiana that doesn't get enough attention. Give them some exposure.
Eric Christopher Xylo.
Okay. Number 3, what's your favorite online tool for building Elevate besides DemandJump?
My favorite online tool for building Elevate.
Yeah, it's something you use every day.
LinkedIn.
Yeah. Number 4, how many hours of sleep do you get every night?
About 5.
And situation, married, single, kiddos?
Single and a freshman in high school, 15 years old.
Oh, very cool. How old are you, Toph?
52.
52. Last question. Something you wish you knew when you were 20.
To always stay true to what you believe the right next step, the right next step is. Stay convicted.
Guys, Chris has been in many industries, got into investment banking before founding his own software company, DemandJump, in 2015. Grew that to $1 million in revenue fairly quickly, first 18 months, raised some capital, realized how VC worked inside of the company, and then said, you know what, man, it's time for me to go give back, and ultimately was recruited in a very competitive process to run Elevate, which is one of the most active seed funds in the world. They've got, you call it the most active in Indianapolis and that Midwest region, with over 500 total investments, $5 billion economic impact, now focused on giving back to entrepreneurs and supporting companies, whether it's software, health tech, fintech, etc. I got a new book out called Pillar-Based Marketing. Check it out. Chris, thanks for taking us to the top.
Thank you.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers. They try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company, or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com YouTube.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.